Hi, I'm Jimmy. In this video, we're going to look at the current strength of the US economy. We're using different economic indicators to see if we can objectively gauge where the economy stands today and ultimately try to answer the question, do we invest now or do we wait for the stock market to crash again? We're going to look at economic indicators like inflation, manufacturing, wages, what's happening with shipping, and hopefully this will give us a good realistic look or a real look at the actual economy. Now, I just wanted to let everybody know real quick that we recently launched a private investing community. We're doing private live streams every week. We're doing a few of them every week. We have an investing Discord. We are building different investment portfolios, answering questions. We're doing a ton of discounted free cash flow calculations. It's really been a cool experience so far, and we're just getting started. So if you want to join us, I'll leave a link in the description below to our Patreon page, which is the gateway which gives you access to the Discord, which is sort of our investing headquarters. You can access the live streams over there. So if you want to join us, link in the description below. Okay, that being said, let's jump right into our economic indicators. And first up, we've got consumer confidence. Now, the first thing that jumps out to me here is that look at this recent action. Just recently, consumer confidence has taken a nosedive, at least over the past reported number, the past month. Now, normally, I think it's a mistake to overreact to any one number like this. But I actually find it interesting. I find it an interesting sign that consumer confidence has dropped below where it first was when COVID hit. That would imply that the consumer, or at least the US consumer, is reacting more today than they were when the world's economies were shutting down, which I think is a very interesting thing to happen. Now, of course, there's a lot behind why consumer confidence would drop like this, and we'll gradually see that as the story unfolds. But when we switch over to our economic scorecard here, well, clearly a pullback in consumer confidence, as big as it was, is going to be a point for the bears. So right now, the bears are leading 1-0. And this is actually huge because the US consumer is one of the key drivers to the broader economy. If the consumer stops spending, that would provide a terrible situation for the broader economy. Now, there are a few possible reasons for the drop in consumer confidence. First, COVID isn't completely gone yet, so that's sort of weighing on things. Plus, inflation is becoming an issue. We'll see that one in a second. And if you've been paying attention at all to the news, well, there's been issues in shipping. I've seen a whole bunch of news stories about cargo ships waiting offshore. So that's a problem. Now, one way to help us measure the health of the shipping industry is for us to look at the Baltic Dry Index. This index measures the cost of shipping goods on some of the largest cargo ships around the world. And we could see that on this 5-year chart, well, shipping costs have gone through the roof recently. Now, the real benefit of looking at the Baltic Dry Index is that it gives us an idea of the supply and demand of goods and ultimately the materials and the raw materials that produce those goods. Now, when COVID hit and the world's biggest economies went into lockdown, well, clearly the demand was super weak, hence a very low price. But since then, well, the demand has been turning higher and the price has continued to rise. Sure, there's been a pullback recently, but not much relative to how much of a run-up the Baltic Dry Index has seen over the past, let's call it the past year. So jumping back to our scorecard, I think it makes sense to give this point to the bulls since the demand appears to be quite high right now, which is ultimately usually a good sign for the economy. Now, along those same lines, just a bit further down the supply chain, well, we have the ISM Manufacturing Economic Indicator. So a lot of the ships on the Baltic Dry Index, they ship raw materials to the manufacturing sector. And this indicator measures the growth within the manufacturing sector. The key level here is 50. Anything above 50 implies positive growth. Anything below 50 implies negative growth. And once again, we can see that the growth in the manufacturing sector has done quite well relative to the past 10 years. So again, this is a strong sign for the economy. So clearly, this is going to be a point for the bulls as well. And I actually think that some of these economic indicators are sort of coming together in an interesting way. Coming off of a rough 2020, manufacturing has been ramping up. But because of that sudden ramp higher and a few other factors, well, the shipping industry has seen an overload of demand. And like we said before, thanks to this higher demand, well, consumers who are concerned that the economy is not running nearly as smoothly as it could be, or at least not as smoothly as it was before the whole COVID happened, well, that's going to cause some panic, hence the pullback in consumer confidence. Now, one of the cause for concern is inflation. Now, there are a few different ways to measure inflation. I recognize that. But one way to measure inflation is to look at the increase in prices of goods and services from one year to the next. So how much did a basket of goods cost today? How much does it cost in 1 year? How much did it go up or down? Whatever percentage that is gives us this chart. And we could see here that prices have increased as fast as they did. Prices right now are increasing as fast as they did right before the financial crisis of 2008 and 2009. Now, clearly, this is going to add to consumer concerns, and this is absolutely going to be a point for the bears. And I also want to point out that, to me, it's interesting. Back in 2008, 2009, consumer confidence, inflation, or the CPI, stuck up there for a very short period of time. Here, it's actually been here for a little while, which is another problem because that implies that the inflation just continues to chip away at what we're doing, chip away at the broader economy. But my real concern with higher inflation, or at least a move like this one, is what is the Federal Reserve going to do next? They could move to reduce the money supply, increase interest rates. Generally, those are sort of the textbook ways to fight inflation. Higher inflation, those are some of the things you could do. But those things also tend to slow down the economy, which is clearly something that they don't want to do. So, over on our scorecard, well, we're all tied up with the bulls and the bears at 2 apiece. Now, I was looking for an economic indicator that could show us how wage growth compares to inflation. And what I found was the wage growth tracker, which is put out by the Atlanta Federal Reserve. And we can see that recently, there has in fact been an increase in wages. And if you're going to have inflation, I'd also like to see an increase in wages, so that's a good thing. But I think it's important to point out that let's call this about a 4% average wage increase. We saw that inflation is sitting over 5%. So again, we're sort of losing out no matter what. You're short about 1%. So although wages are going up some, they're not going up as much as the price of goods and services. So over on our scorecard, well, I think that rising wages is probably going to be a point for the bulls. But again, for me, the real question from an economic perspective is what is the Federal Reserve going to do about inflation? I think that inflation is the wild card with the whole thing. And I think the Fed is on very thin ice. Although the economy is showing some signs of strength, there is simply, the Fed is in a no-win situation because what are they going to do? Increase interest rates? If they increase interest rates right now, the consumer is already concerned. What does the consumer do at that point? You'd slow down the real estate market, which is one of the strengths of the overall economy right now. So I think that the Federal Reserve is really in a no-win situation. And I think that trying to predict what they will do next is probably a mistake for us. I think we're far better off coming up with our own investing plan. With that being said, and to answer the question, do we invest now or wait for the stock market to crash? And first, and I think the cleanest answer, is that for those of us who are dollar cost averaging our investments, I think it continues to make sense doing that. None of this really matters if we're just dollar cost averaging. We're putting money into our 401k or into an investment account and automatically investing it every week or month or quarter, whatever the time period is. I think we should keep doing that no matter what. But beyond that, if we're trying to outperform the market, if we're trying to increase our overall performance, I think that when we look at the stock market here, well, it seems that the stock market could be overvalued and a correction is perhaps overdue. But I don't think it makes sense to wait for that correction to happen. I think it makes more sense to try to find cheap stocks in an overpriced market. We are far better off to have strong performance if we don't overpay for our stocks. And if the stock market does in fact break lower, well, at least we paid a reasonable price. If we overpaid and those prices correct, that could really hurt us on the downside. Now, the good news is that we're finding more and more stocks that appear to be undervalued over in our private investing community. Over there, we do these 20-minute live streams every week. And one of the live streams that we do is where members of the community throw out a bunch of tickers at us. Here's a bunch of companies, and we built us an Excel spreadsheet that we can quickly calculate using analyst estimates what the fair value appears to be using discounted free cash flow. So we've taken a bunch of the companies that people are throwing out, we're punching them in, and much to my surprise, we're ending up with a decent amount of names that could be undervalued. So I think it makes sense for us to start with those types of companies. If we could avoid overpaying for a stock, we're far more likely to do well with investments in general over the long run. Now, I actually put these charts, if you're curious to see them, I actually put these charts up on the investing community, plus a few others that I didn't include here, but I thought were interesting. So if you're curious to learn about these types of economic indicators, or even how to build portfolios, or how to do deeper dives on companies, I actually recently posted a video in the community it was a question about utility stocks, how to value utility stocks. And in the community, we've been doing some sort of exclusive community content where we put up videos answering different questions. If you're curious to if you're on the fence as to whether or not you should join the community, and if you're curious to see the type of video that we have up there, this could be a good next video for you to watch. I'll leave a link right here. I'll leave a link in the description below. And thank you so much for sticking with me all the way to the end of the video. I really do appreciate it. Thank you, and I'll see you in the next video.